Economic news took main stage for the first week of the year. From housing and consumer confidence to job growth and a strong third quarter GDP, things are looking up for 2014. This is all happening on the back of the Federal Reserve, or Fed's, decision to slow down its monetary support for financial markets, using a tool we call quantitative easing, or QE. With an unemployment rate near 7%, we're getting closer to what we consider a normal rate of 5%. But that means we still need about 7.5 million more jobs created just to get us back to even. Unemployment is a huge indicator for how well the economy is doing, and it's one way the Fed determines its support for financial markets. And now that jobs have gained speed, Fed support is about to slow down. Not everyone is singing a happy tune about job growth, though. Federal extended unemployment benefits expired at year end. It's good for the budget and is a sign that the economy's health is picking up. But it's bad for the roughly 4 million people who will be affected this year if it's not reinstated when Obama returns to Washington. Stocks were a slam dunk for 2013, up over 25% in the US and strong globally. There's not much this week can tell us about the coming year, though, so don't read too much into the minor losses. It's not really surprising after such a bullish run. Anything can happen, but don't forget, it would be normal and even expected for domestic markets to encounter muted returns or even losses in the next few years. That's why diversification is key. Don't put all your eggs in one basket. Bond markets were in stall speed this week, waiting for the holidays to wrap up. So right now, the yield on the 10-year U.S. Treasury, a benchmark for other bonds and mortgage rates, is about 3%. That's a lot higher than it was a year ago, which means prices should be a lot lower, and they are. For now, we're just looking forward to the January jobs report, always a big deal for bonds. And back to the really big stuff, quantitative easing. The Fed helps support financial markets, and this is how it all starts. All that money helps push interest rates down, and it's helped stocks a lot. But the Fed is about to take its foot off the gas. It's the end of Bernanke and full throttle QE, and there's even a new head of the Fed, Janet Yellen. It's all a big deal. We can't be certain how this will affect financial markets, interest rates, inflation, or even economic growth. We'll be talking about this a lot, so watch out for videos that discuss quantitative easing and the changing of the guard at the Federal Reserve.